While fears of low interest rates having dented margins and rising asset quality woes due to the pandemic grappled the banking stocks recently, private sector banks seem to have steered clear of such tremor. Here, we discuss their December 2021 quarter performance and assess how these banks fared. While overall bank credit grew by a tepid 6.7% in December 2021, all four private, HDFC Bank, ICICI Bank, Axis Bank and Kotak Mahindra Bank lenders demonstrated double-digit growth, in the range of 16 to 18% YOY. Much of the growth came from retail loans that now constitute 40 to 60% of portfolios for these large private banks. Within them home loans and LAP were the major contributors. Kotak saw a 38% spike in this segment. The other banks saw their mortgages inch up by 17 to 23% YOY in the recent December quarter. While growth in retail credit promises granularity, the pandemic and the ensuing sporadic lockdowns may lead to systemic shocks in the asset quality front. Higher growth in unsecured portion of retail loans, personal loans and credit cards warrants more caution. While such loans constitute 15 to 16% of the portfolio for HDFC Bank, ICICI Bank and Axis Bank, it merely constitutes 5% in Kotak's book. Per the RBI's recent financial stability report, such systemic shocks are plausible in the small-medium enterprises and microfinance portfolios of banks. While the large private banks have limited exposure to microfinance, loans to SMEs comprise 7 and 10% of loans in the case of Kotak and Axis, respectively. Besides, the banks saw a near 21% growth in their SME portfolios in the December 2021 quarter. While ICICI too witnessed a 34% jump in the SME loan portfolio, it merely comprises 4% of its overall loan book. HDFC Bank's commercial and rural banking segment, excluding agricultural loans, too spiked by 30% in the quarter gone by. Resurgence of corporate credit was also witnessed in ICICI and Axis, whose corporate loans inched up by 12.5% and 13% respectively. The other two banks, whose corporate loans comprise 25% of overall loan book, also saw a 7 to 8% rise in such loans. Despite such prominent growth in credit offtake, banks had to bear the brunt of falling yields, given the low interest rates in the market. However, private banks were able to cushion the impact through a healthy traction in deposit mobilization. While Axis stood out with a 20% growth, the deposits of the other three private banks were up 14 to 16% YOY. Besides, the growth in deposits were largely led by low-cost CASA deposits, that makes up for 44 to 47% of their overall deposit. Kotak's CASA ratio is however higher at 60%, and these grew by 17% in the December quarter. Owing to the healthy CASA mobilization, the net interest margins of ICICI Bank and Kotak were up 29 and 26 basis points YOY, respectively. While Kotak and HDFC Bank were long known for their superior NIMs, ICICI too joined the league with 3.96% NIM. While Axis Bank's NIMs were down 6 bps YOY to 3.53%, its spike since September 2021 quarter, up 14 bps, is no mean feat. This is because Axis had been grappling with margins lower than peers, owing to heightened interest reversals and weak loan spread. However, the December 2021 quarter saw some signs of improvements on both the asset quality front and in loan spread. The banks also contained their slippages well in the December quarter. Both ICICI and Axis saw their legacy issues waning, with over a 100 bps drop in their gross non-performing asset. Though the restructuring 2.0 was extended until end of December, the drop in GNPAs came from healthy recoveries and write-offs only. For instance, restructured loans comprise just about 0.63% of overall loans in the case of Axis Bank. While Kotak's GNPAs were down 56 bps, HDFC Bank too saw a 12 bps drop despite having the lowest GNPA of 1.3%. With the highest margins and lower exposure to high-risk segments, the stock of Kotak Mahindra Bank continues to trade at 5 times its price to book, while HDFC Bank with a tad lower set of margins and a much bigger balance sheet size trades at 3.7 times. While these banks continue to be our preferred picks, their current valuations are 7 to 9% higher than their 3-year average multiples and hence lower the risk-reward for fresh investor. In our previous roundup on large private banks, we had indicated that ICICI Bank could see a re-rating in earnings if legacy issues in corporate book continue to fade in coming quarters, while recommending an accumulate on the stock. With the bank's improving metrics, it now trades at 3 times its price to book, 27% premium to its 3-year average multiple. Axis too has demonstrated improvements in operating metrics. It was a long-drawn overhang on the stock. It now trades at 2.1 times its price to book, just 3% higher than its 3-year average valuation. We reiterate our hold call on the stock until the metrics improve further in the coming quarter.